Welcome. So let's look at how we navigate the real estate market. And I say navigate because real estate cannot be explored or looked at in isolation. We need to understand how the economy is working. We need to understand the regulatory implications. We need to understand demographics. We need to understand how interest rates and how geopolitics are impacting decisions. We need to have an appreciation of all of these different things to see what that means both for value and for the long-term potential of different types of properties. So let's dive in together and look at, first of all, how the economy impacts the real estate market, and then work our way through that to see how we segment the market and what decisions we make when the market is moving up, but also when it's moving down. There's always money to be made. It just needs to be in a different way at different points in the cycle. So let's start by exploring what are economic and real estate cycles. When we look at cycles in the economy, in essence, we are looking at three different things. GDP, gross domestic product, right? Whether the economy is doing well, it's going up, not doing so well, it's coming down, right? That's the first. The second has to do with employment. So are people finding work? What percent of the population is fully employed, etc. And then the third has to do with disposable income. Yes, people have work, but do they have the money needed or available to spend to buy real estate? So when we look at the economy, the three key indicators that we want to explore is how well is the economy doing? Do people have jobs and do they have money to spend, especially when it comes to real estate? Typically, we break an economic cycle into four parts. There is the expansion phase, when things are going great, the peak, then the slump, and then the trough. So you're looking at the economy moving up, peaking, turning down, and then reaching the bottom. What happens at each of the different stages? When things are going well, economy is growing, unemployment is coming down, more people are finding jobs, salaries are increasing, construction typically kicks in, and demand outpaces supply. As more demand is satisfied, but investors have rushed in to provide a lot more real estate, attracted to these higher prices, the economy reaches the peak. Right? So at that peak level, you are looking at the economy still doing very well, unemployment being at a very low rate, salaries at a high amount, but things begin to feel a bit off. You are beginning to look at people not being so confident about what lays ahead and whether this growth, this momentum is going to continue. And then something breaks. Interest rates rise, energy costs rise, a big employer goes bankrupt. Something happens that jolts the economy and removes confidence from the system. At that point in time, the market begins to turn. But what happens? Real estate, being inelastic, continues to be under construction. So whilst demand for real estate subsides, all these properties that are under construction continue to be executed. So whilst the market is moving down, you're continuing to add supply to it because all these properties that were under construction either during the boom or the peak period are now being delivered to the market at a point in time when the market has actually turned. So what happens? That pushes real estate prices down even more, exactly because there's more supply hitting the market, demand is lower at the same time, so property developers and sellers begin to realize that they need to decrease the prices, provide discounts, be more flexible when it comes to certain terms, so that they can capture whatever demand is out there. At the trough, at the bottom, at that point in time, you have no construction, very little demand, and nothing is really moving in the real estate market. You always have transactions, you always have rentals, there's always investments to be made, but activity tends to be quite low. And that's where a new breed of investors comes in. The high-risk takers, the bottom feeders, those who are looking to take advantage of their position, of their availability of capital to take a position and acquire opportunities, whatever that is termed, which we will explore later on. So let's use Greece as a recent example of what is happening in terms of a market cycle. Greece has come out of the economic crisis in the past 6 to 7 years. From 2016 onwards, the economy is performing quite well, with GDP growing, unemployment coming down, and progressively salaries increasing. At the same time, what we are seeing on the real estate side can broadly be broken down into three parts. From 2016 onwards, we saw a big inflow of investment in real estate, mainly second-hand real estate, residential properties, properties that are converted to Airbnb. We also saw a lot of investment coming in around hotels and leisure. So at that point in time, the market was at the bottom. Investors were attracted due to the low prices, but also due to the fact that there was increased stability in the Greek economy, particularly when it came to the government having a strategy as to how things would move forward. A lot of money came in, bottom of the market, and that's where a lot of the great transactions happened. From 2016 to 2020, up to COVID, we saw more institutional money coming into Greece. Office buildings being acquired, shopping malls transacting, and so on and so forth. The biggest institutional investors gained confidence, so they moved in to take positions. We also saw the acquisition of big land parcels, especially at the end of the decade, where new construction finally started in the Greek market. The period during the lockdowns of COVID caused the market to stay at a relative standstill, but with COVID and the COVID situation done, money flowed into the economy, especially around the Golden Visa program, so money coming into Athens and then going to the islands and beyond as the government changed the geography to which investing in this type of real estate could command a golden visa. But then also we saw more institutional investors coming in to acquire income-producing assets, both local and from overseas. Over the last 2 years, what we are seeing is a slowdown in the market. Yes, the Golden Visa program has helped a lot with money coming in, but the increases in property prices have been considerably higher than the increases in salaries and disposable income. So what we are seeing is a lot of money has come in, new construction has started around Golden Visa, offices, green buildings, etc. A lot of money is going to logistics, more recently it's going into data centers, but at the same time, exactly because salaries have not increased for the majority of the population, and exactly because we have a high percentage of non-performing loans that are sitting outside the banking system in the hands of the various loan servicers, demand for real estate from the average Greek is not there, or is not there at high levels. So there has been a softening of demand for residential real estate, although it's still there and it still is untapped for many to explore and exploit. So we took the economic cycle and the real estate cycle, we broke it down into the 4 components. So where is it best typically to invest in at different points in the cycle? During the growth phase, you want to be in unique properties. For example, high-end residential is the one that is likely to perform really well. Core commercial real estate, so office buildings in the center, hotels by the beach, etc. So as the market is moving up, you want to be in the best type of real estate because those are the ones that are going to have the biggest increase in value, and those are the ones that you're probably going to find it easier to offload as the market moves into the peak segment. As we move to the peak segment, we're looking to do two things. First of all, we're looking to offload some of the properties acquired, probably the high-end, top-quality properties that were acquired during the peak phase. And then we're looking to position ourselves to have more cash with the expectations that more opportunities are down the line as the market begins to turn. So this is the point where decisions need to be made around offloading some of the gems in the crown. Phase 3 is the contraction. So the market has started to turn. There you can find some really interesting opportunities exactly because of the mismatch between demand and supply. Demand will start going down, but supply will continue to flow through, especially for new properties that are started and are under construction during the preceding period. A lot of developers, especially those who started construction right at the peak, are going to find themselves in a difficult position, especially those who have borrowed heavily from banks or other financial institutions to finance whatever development. That's where equity can step in and you can buy good quality real estate at discounted prices. Make sure, however, that the developer is in a position to complete the project and finish it, or else you are running the risk of remaining with something that is incomplete and effectively you have burned your cash. So as the market begins to move down, demand falls first, supply follows through, right? And this creates this misalignment in the markets, and that's where the opportunities arise. So what do we do when the market is right at the bottom? How do we position ourselves? How do we know it's actually at the bottom? There's no real way of knowing. What we do know is that right at the bottom, when things are dark and when there's nothing out there, what you can rely on is demographics. And demographics are a key indicator of how things are going to progress. In a country with a growing population, lots of kids, for example, there you know that demand is going to come through for family housing, it's going to come through for schools, it's going to come through for anything that is activity-based, kindergartens, etc. Similarly, if the population is aging, you are looking at old people's home. If the economy is transitioning into retail, online retail, e-commerce, etc., then logistics will play a bigger factor. So demographics and how the economy is changing is where you need to make strategic decisions of where you position yourselves. More often than not, is at that point in time where three key investment decisions often pay off. First, city center, good quality properties, right at the bottom of the cycle, always outperform everything else. Second, buying prime land, either by the sea or with sea views, will also likely perform really well due to its scarcity. And then number three, buying multi-tenanted buildings, typically residential, are the three key things that are going to perform well. The first one, you are buying due to location, strategic positioning, good quality asset. The second, land by the sea due to scarcity. And the third, the multi-tenanted nature means that you have a diversified income, you can add value probably by refurbishing things, and because things you expect are going to move up, it means that you can increase rents and command a higher return on your investment.